if you're going to rely upon a virtual protocol to create security, you'd be better off to stake the protocol with an asset that is outside of the network. I would say the logical thing to do in business is you don't worry about what happens 16 to 20 years out. If you can make a ton of money now, I mean, you might very well make enough money now to have 10, 20, 30, $100 billion of capital then, at which point you can go buy something else. We're in a gold rush right now, or a Bitcoin rush, call it.
Right.
Between now and like 2035, in 2035, we'll have mined 99% of the Bitcoin.
Right.
So you've got 14 years. And during the 14 years, the block rewards are pretty high, relatively speaking. And so it's very lucrative to be in the business, but the business is going to become less profitable, likely. At the very least, we know it's going to rotate into a transaction fee business. So instead of 90% block reward, 10% transaction fee, you could expect 90% transaction fee, 10% block reward. And the transaction fees are also going to scale more likely with the log of the price, not linear to the price. If I want to move $1 million, I might pay you $10. And if I want to move $10 million, I would pay $12, but I'm not going to pay $100. I'm just going to overbid the $1 million buyer. And if I want to move $50 million, I'll bid $14.
Yeah.
So the transaction fees will increase with the number of, transactions on the base layer. And that'll be a dynamic, but the block rewards go away. And so if you're a Bitcoin miner, it's a very lucrative high growth business right now, but it will move toward an efficient transaction security network later. And you would do well to buy Bitcoin, right? That's why it makes sense to hodl Bitcoin if you're a Bitcoin miner, because it's your hedge. If Bitcoin, it's a hedge against two things, right? It's a hedge against the inevitable protocol, which is the protocol says Bitcoin mining is going to get 90% less lucrative over the course of, right? Cut in half once, cut in half twice, right? Over the course of 12 years, you get cut in half 3 times. So it's a hedge against that, but that's a long term. It's also a hedge against the near term hash rate explosion. If you're mining Bitcoin right now, and if somebody comes out of the blue and they bring a lot of hash rate on the network faster than you expected, then your market share gets cut. In that situation, Bitcoin may win. If everybody believes Bitcoin's going to win and there's a flood of people that enter the mining business, you want to own Bitcoin. Mining's going to get competitive. Bitcoin's going to get more valuable. So you definitely don't want to be in a situation where you mine Bitcoin, you sell all your Bitcoin for cash, and then in that case, you're attempting to run a cash business in 16 years when the revenue's been cut in half 4 times.
Right.
Right. And presumably if you cut 100 to 50 to 25 to 12 to 6, when you're generating 6% of the revenue and everybody else has had 12 years or 16 years to get in the game, it's going to be more of a commodity business.
Right.
But that's, so that's my thought on the Bitcoin mining network and the dynamic model over time. I think that some people intentionally misunderstand this, like people that are like proof of stakers. They intentionally misunderstand it, because if they misunderstand it, then they can assume that energy consumption is linear, and then they can, play the ESG card and pretend that they're, they can do their virtue signaling and say they're doing something good for the environment because they're not using energy. Right. But the truth is they're not using energy, nor are they using technology. They're not using hardware technology, engineering technology, or energy, nor are they submitting their network to competition. and they're not using external capital, political or financial. What they're doing is they're creating a protocol, a virtual protocol in order to create security. And even there, if you're going to rely upon a virtual protocol to create security, you'd be better off to stake the protocol with an asset that is outside of the network, that is external to the network. So for example, the Lightning Network makes a lot more sense because it's staked with Bitcoin than if it was staked with Lightning Coin. Now, that's not to say that a Bitcoin miner can't compete and evolve. It may be a great business then too. It may be that Bitcoin miners evolve to be running Lightning nodes or running layer 2 platforms of other sorts. You know, it might be that as a Bitcoin miner, you have a huge Bitcoin treasury and then you can generate yield on it. It might be that there are other applications. We'll talk about some. It's very logical for Bitcoin miners maybe to get into some of these other application areas that will pop up in time. And there are technology possibilities here. So I would say the logical thing to do in business is you don't worry about what happens 16 to 20 years out. If you can make a ton of money now, I mean, you might very well make enough money now to have 10, 20, 30, $100 billion of capital then, at which point you can go buy something else to get you into business. And my other point, I guess, here is, yes, it's true Bitcoin miners should keep Bitcoin, but it's also true that non-Bitcoin miners should keep Bitcoin. If you believe in Bitcoin, then the logic follows that no matter what business you are in, if you have operating income, you should invest in Bitcoin.
Right.
And if you are able to generate financing, if you can raise debt or equity, then you should also raise debt and invest that in Bitcoin. So that would be the case for other companies. Like MicroStrategy looks at it that way. We're not even a Bitcoin miner. And so it's very important that if you're building something that you want to last for 1,000 years, you respect politics, and you respect thermodynamics, and you respect physics.
Yes.
And proof of work is this is very creative invention to continually connect and synchronize the Bitcoin network with political physical reality.
It's holding
never ending evolution. Every 4 years, every 2 years, new miner, a new chip, a new place, a new thing. Throw away the old. The old generation has to die, so the new generation can form, so that the creature can evolve. Otherwise, the creature stagnates and becomes progressively more fragile. Until it's no longer capable of competing in the real world.